For more on the impact of a possible Fed rate hike on emerging markets, I spoke to Joseph Mariathasan. He's a partner with Pangaea Finance Partners and contributing editor for Investments Pensions Europe. And I asked whether other emerging markets are prepared.
Well, it's a bit like sitting an exam, you know. The apprehension is always much worse than the actual exam itself. And as we get closer, it becomes more and more certain we're going to see a Fed rise. Basically, uncertainty has come down, and people's idea of fear has come down. Emerging markets as a whole really suffer from risk or misplaced risk perception. So what they actually require is some sort of certainty. And once the Fed starts its upward rate cycle, that uncertainty that's been really dogging emerging markets for 6 years or so would have disappeared. I think it's all in all a great benefit.
Do you think from covering this topic for so long now that the emerging markets, and quite frankly all markets around the world, just want the Fed to get it over with, just raise the rates,
oh, absolutely.
be done?
Yes, absolutely. And also, I think everyone wants the Fed to move the world back to a normal economic environment. I mean, what we've been seeing has been quite bizarre and abnormal. I mean, it's been an experiment. We all know that. No one's really too sure whether the experiment has worked. But what we do know is that what we're seeing aren't normal economic conditions. The idea of QE is not a normal economic function. The world needs to gradually move back to some sort of normality.
Why then are all these different experts coming out and saying that if the U.S. raises rates, it would have such an adverse impact on emerging markets, it would have an adverse impact on the carry trade, et cetera, et cetera? Are these experts, are they telling the truth?
Well, to be honest, everyone knows rates have got to go up. The issue is not whether rates go up, but at what speed and at what certainty. I think that's the key point. You know, you can have different cycles or different scenarios for rate rises. Everyone knows rates got to go up. The question is it going to go up unexpectedly? Is it going to go up quickly? Or is it going to go up steadily and slowly with some sort of measured thinking behind it? And that's what everyone is actually hoping for. And that would be the best outcome of all. Clearly, if rates suddenly shot up by huge amounts, it would cause enormous disruption. But I think a 25 basis point hike is not going to make any disruption at all. It's already been priced in.
Why does China care about all this?
What is China? Well, I think one of the most profound changes we're seeing in the world today is China becoming a normal nation, a normal trading nation. Now, we're seeing huge amounts. I was in Shanghai last week, and really you can see huge amounts of two-way flows now, not only foreign direct investment into China, but one of the biggest flows we're going to see in the world now is Chinese domestic savings moving offshore. And we're already seeing this in the form of purchase of trophy property assets. But what's interesting now is that the retail savings platforms in China are now looking to invest in foreign assets. So a strengthening dollar, a strengthening US interest rates will make that move look even more attractive.
This issue of a normal interest rate, and we've talked about this before in the past, that having a low interest rates means low deposit rates at banks, which ultimately hurts senior citizens and those on fixed income. What is a normal yield curve? What should interest rates ultimately be a year or 2 years from now?
Well, ultimately, there's so many different answers to that, depending on who you're asking. And really, the issue, I suppose, is should interest rates reflect the inflation expectations plus the small premium? Should they actually be used to control inflation? Should they be used to dampen down the economy? And there's lots of conflicting stories. What you can say is that the situation you have in Europe, for example, negative interest rates in 40% of the Eurozone government bonds, is clearly dysfunctional and bizarre. What you can say is interest rates of less than 0.5% at the moment are clearly dysfunctional and bizarre. What you can't say is whether interest rates should be 1.5% or 3% or 4%. But they're going to be somewhere within inflation plus or minus 1%, I would have thought, would be acceptable and normal and the sort of environment that everyone would feel comfortable with.